Amazon is riding high on a wave of impressive Q4 results, surpassing expectations across the board thanks to robust holiday sales and substantial growth in its cloud business. In the December quarter, the company's top line saw a 14% year-over-year surge, and the operating income skyrocketed, growing more than fivefold compared to the same period in 2022. The upbeat momentum looks set to continue for Amazon throughout 2024, fueled by strategic investments in artificial intelligence and an overall positive macroeconomic environment. The company's focus on Amazon Web Services Gen AI solutions, coupled with a strong showing in retail e-commerce, positions Amazon for success in the coming year. Taking these factors into account, we're pegging a fair share price of $223, signaling a potential 30% upside. In light of this optimistic outlook, we can adjust our rating for Amazon to a hold to a confident buy. The e-commerce giant seems well-positioned to capitalize on AI trends and consumer sentiment, setting the stage for new all-time highs in the near future. Putting Amazon's recent performance into perspective, its shares have lagged behind the broader equities market throughout 2023. Over the trailing 12 months, Amazon shares experienced a 52% decline, a stark contrast to the 19% gain seen in the S&P 500. Breaking down the numbers, Amazon presented its Q4 2023 financial results on February 1st, surpassing analyst predictions for both revenue and profit. During the September to December period, the company raked in group revenues totaling $169.86 billion, marking a robust 14% year-over-year increase. This outperformance of analyst consensus by $3.7 billion was attributed to an exceptional holiday shopping season. Looking at the entire year, sales grew by 12% year-over-year, reaching $574.8 billion. In terms of profitability, Amazon reported an operating income of approximately $13.2 billion, a substantial leap from the $2.7 billion reported in Q4 2022. Net income stood at $10.6 billion, $1 per share, surpassing estimates by nearly $2 billion, $0.2 per share. What's intriguing is that this positive momentum in profitability wasn't confined to one sector. It spanned across major segments, including international, North America, and Amazon Web Services. This suggests a well-anchored expansion of margins across Amazon's entire business. Taking a broader view of profitability over the trailing 12 months, the operating income has surged to nearly $36.9 billion, nearly tripling the profits recorded for the corresponding period 1 year earlier. This indicates a robust financial performance across the board for Amazon. Amazon's retail prowess has been thoroughly celebrated, but let's not overlook the stellar performance of Amazon Web Services in Q4. The segment witnessed a 13% year-over-year surge in its top line, reaching $24.2 billion, and operating profits leaped by an impressive 38% year-over-year, now standing at $7.16 billion. Delving into the cloud business's success, Amazon's management shed light on substantial deals with major players like Salesforce, BMW, and NVIDIA. This underscores Amazon Web Services' robust customer pipeline and the trust clients place in its services. Notably, significant strides were made in Gen AI, with Amazon Web Services concentrating on 3 layers of the Gen AI stack. They rolled out products like Trainium 2 for AI training, Bedrock AI for harnessing large language models, and Amazon Q, a kind of work productivity companion boasting features akin to ChatGPT. Zooming out for a broader view of Amazon's growth outlook, it's heartening to see analysts, as per data collected by Seeking Alpha, projecting an 11–12% top-line CAGR through 2026. This underscores a positive trajectory and sets an optimistic tone for Amazon's future growth. Now, diving into the nitty-gritty of Amazon's stock valuation model, capital charge for this, I'm looking at Amazon's cost of equity, which is at 835%. Think of it like the price tag on using someone else's money, future growth. After 2025, I'm expecting a growth rate of 4.25%. Why? Well, that's a bit higher than the world's GDP growth, and it reflects Amazon's plans to ride the wave of AI through Amazon Web Services and its knack for venturing into big growth opportunities like streaming and pharmacy. In the December quarter, Amazon experienced a 14% year-over-year growth in its top line, while its operating income soared more than five-fold compared to the same period in 2022. Looking ahead, Amazon is anticipated to enjoy a robust year in 2024, fueled by investments in artificial intelligence and an improving macroeconomic landscape. Despite the recent 8% uptick in shares following a stellar Q4 performance, Amazon stock still lags about 7% below its all-time highs of $184 per share set in November 2021. However, buoyed by optimistic management commentary for the year ahead, there's a strong likelihood that Amazon shares will soon revisit and surpass their previous peaks. Employing a residual earnings valuation framework, the analysis suggests a fair share price of $223, signaling a potential 30% upside. Consequently, the rating is upgraded from hold to buy. Amazon's Prime Video is making waves in the streaming realm, boasting earnings that surpass expectations. The streaming industry is intensifying its competition, with companies focusing on maximizing revenue per user. Amazon is elevating its game by increasing its investment in content, positioning itself as a formidable player in the streaming market. Shifting the focus briefly to Netflix, their recent fourth-quarter earnings showcase a 12.5% year-over-year growth in revenue, hitting $8.3 billion, despite a slight miss in earnings per share (EPS) estimates, resulting in a 3% surge in stock. The topic at hand is not Netflix, but rather the future landscape of the streaming industry. On February 1st, after market hours, Amazon's shares soared over 7% as the company's fourth-quarter earnings outperformed analyst predictions. Amazon raked in $170 billion in revenue for the quarter, marking a substantial 13.9% year-over-year growth. With an EPS of $1, Amazon exceeded analysts' consensus estimate of 80 cents by an impressive 25%. This achievement gains significance when considering that in Q4 2022, Amazon fell short of EPS estimates by 17 cents, delivering just 3 cents. The positive news provides investors with much to digest, fostering optimism that Amazon, with its diversified business units, is well-positioned to grow its Prime membership and enhance its margins, making it an appealing prospect for long-term investors. The emerging synergies among Amazon's various business components are seen as a positive indicator for profitability and investor returns. Amazon pulled in a whopping $14.6 billion in ad revenue in the last quarter, Q4. And here's the kicker, they hadn't even launched ads on Prime Video yet. Just to put things in perspective, Amazon is now the third highest earner globally in terms of ad revenue, trailing only behind Google and Meta. Now let's talk about Prime Video's triumphs. Amazon's expertise in advertising, technology, and media is clearly paying off. In comparison to its major US rival Netflix, which posted impressive earnings by adding 13.12 million subscribers in the last quarter, totaling 228 million, Amazon's Prime members are proving to be more lucrative. Though Amazon has around 200 million subscribers globally before Q4, they spend big, around $1,400 per year per Prime member. Most of this spending happens on their marketplace, but now Amazon is smartly monetizing this valuable user base, particularly through Prime Video. Speaking of Prime Video, it's been quite a quarter for them. Thursday Night Football, TNF viewership, surged by 24%. The Seahawks-Cowboys game on November 30th became Prime Video's most-watched TNF game ever, with a whopping 15.3 million viewers. Returns from the MGM Studios acquisition are rolling in. With 16 films and series released in the quarter, Prime Video is not just about quantity, but quality. For instance, Reacher, Season 2, topped Nielsen's Top 10 Originals streaming chart. The second season of Invincible became the most viewed animated series ever on Prime Video globally, and the holiday comedy Candy Cane Lane ranked among the top 10 most-watched worldwide film debuts on Prime Video. But that's not all. Recognizing that live sports and news are crucial for cord cutters, Amazon is making strategic moves. They released sports documentaries, expanded live content with new broadcast rights, and spent a hefty $19 billion on content, video and music. In 2023 alone, this substantial spending might seem excessive, especially since most of it comes with a Prime membership. But it's Amazon's way of investing big to lead the streaming game. Initially skeptical, now fully on board. The evolution of streaming took a big leap in 2005 when Adobe snagged Macromedia and YouTube entered the scene. YouTube, despite not being the first, is often seen as the pioneer of video-on-demand streaming, changing how we watch TV forever. In 2007, Netflix joined the streaming party, backed by its DVD rental business, and the rest is history. Interestingly, Netflix once proposed a merger with Blockbuster in 2000, asking for $50 million and offering to run Blockbuster's online brand. Blockbuster laughed it off, and we all know how that turned out. So, what sets successful services like Netflix apart? Netflix understood its customers, adapted to change, and treated its users well, unlike Blockbuster, which relied on late fees. A major customer turnoff, Netflix's customer-centric approach and adaptability have propelled it to its current status. But what's next for the streaming giant? Streaming is on the rise thanks to our growing online lifestyles, especially among Gen Z and millennials. However, too much streaming has led to subscription fatigue, with about two-thirds of people canceling at least one service in the last year. Amazon Prime, while popular, saw the most cancellations. Reasons for canceling include services going unused and being too expensive.